Okay, so, all right, bet. So what is liquidity? All right, so the way you got to think about it is, even when we, let's just say like us as traders, when we enter a trade, okay, like let's say we enter right here, all right, we entered, right, because we rejected the EMA, awesome, great entry. But us as traders, when we enter a trade, we are considered liquidity, okay, because our order is a live active order in the market, and it is a price target that this price may eventually want to go take out, because if they can take us out, that's just more money added to the market to make the market push down or push up more to go take out other traders. The way you have to think about liquidity in the market is, again, it's just a big game of winning and losing, right? So for instance, right here, all right, we have this swing high. So it's a swing high because this obviously is the highest place that price went, but we know there's a bunch of selling orders sitting like right here and right here and right here, because that's the only way that price would push down from this key area of interest. And that's how you got to kind of look at liquidity, is areas of interest, because right here, a giant buying, right? Giant buying pressure out of this area right here. That means there's a bunch of buying orders down here that eventually price is going to maybe go, let's just say, take out this high first, right? Go seek this liquidity, go seek these orders, get their money, and then use that to make that big selling push down to go take out these buyers. And if you see, like, even on a smaller time frame spectrum, but like a shorter period of time, like you just see it happening over and over again, right? So like right in here. So for instance, everybody that bought, like, let's just say like here, right? You bought from here, price is going up. That's awesome that you bought from here, right? You're making money. So now you're holding and holding and holding. At some point, price comes down, as we see right here, takes out the people that bought here because this was not a good entry, and then continues and makes its way up to take out all the people right here that sold previously. So it's just a big game of sweeping each high and each low. And then we can take it out too, because this is on the 1 minute time frame. We can take it out to, let's just say, the 1 hour time frame, and we'll look at a bigger overall, you know, like basis of what's happening. So for instance, right here on the 1 hour, and I'm about to explain to you how you can use this to determine like an entry point on the lower time frame. All right, so again, I say this all the time, and I'll say it again, like for anybody that's newer, remember, the higher time frame rules the market. So for instance, if the 1 hour is pushing up, that means that on the 30-minute, 15-minute, 5-minute, and all that, it's printing those little time frame candles to even make that 1 hour candle. So if we are pushing up heavy on the 1 hour time frame, we know that, okay, if we're dropping down into a lower time frame, we only need to be looking for buys, because that just makes the most sense. That would give us as traders the best probability to make the correct trade and predict where price is going, because this is all a game of probability. But back to liquidity. So for instance, like right here, all right, price doesn't know where it wants to go. It's moving sideways, right? No real up and down direction. Okay, so then we come down to this level of interest, key area, a 62.5 key level. You can note that down too. I'll go over that in a different video, but that's also in the concepts tab as well. So we're rejecting right here. We create these lows right here. Here, and I'll actually grab my little tool. We got these lows, and then if you notice, right, again, we don't know where we want to go with price. Price is just moving up and down, up and down. This is not good to trade in. We need to see a low or a high be swept first before we can determine which way price wants to move. So as we're printing these lows, right, we're watching the market, but right here, right, we get this big spike down, okay? And what did we do? We took out this low, which is liquidity. Because again, I said, right, if we're buying right here, as soon as you enter the market, you're technically liquidity. So if you bought right here, yeah, price went up and did its thing, but at some point price came down, took out these orders because their stop loss was under here, came down, and then it did not close under this low. So when it doesn't close under this low, comes down, sweeps it, and then rejects back up, and vice versa from the upside as well, like right here. But when it does this, it's showing that we come down, get those buyers to make that. Now we got to push up. Another way to like think about liquidity is like a rubber band, right? Or like a slingshot. For it to move in one direction very, very fast, as we see right after it came down and took out this low, what did price do? Skyrocketed, right? For price to be able to actually move in one direction for a long period of time and move with volume, it has to pull back first to get that big push out, right? Like a slingshot, you'd have to pull the slingshot back and then it would, launch whatever. Same thing with price, okay? Yes, we know price is moving up because we're creating, right? We're creating lower highs, different things like that, or higher lows, my bad. We're creating higher lows. And at some point, we got to see some liquidity get swept to actually keep pushing up, And that's just how the market moves. It moves in waves. But you got to look at it like a slingshot, right? Price pulled back, took out this liquidity, and then absolutely shot off from there. Are there any questions right now, like while, I'm starting this? Are there any questions about what liquidity is? Anything about the market? I'm watching the chat too, so you guys can type in the chat, or you can just ask me. All right, for instance, now it didn't fully go to the next high right here, but again, so we have these lows being made, right? And we're moving bullish, we're moving up in the market, obviously creating the lows, creating higher highs, higher lows, but we know we want to push back up. So in order for us to enter in a buy here, this is too high to enter for a buy. We want to get the pullback. Now what did price do? Price pulled back here, took out these lows and this low as well, and these are zones of liquidity. It took out that low and instantly rejected it and then pushed back up. Now how do we have a take profit from this? Okay, so if you are buy bias and this would be your entry point right here, after it comes and takes out a low, you would enter here, right? Not necessarily just enter because it took out a low, I'm not saying that. You would obviously have to have some type of confirmation within here, but you could use your next indication, like where price is going to go, to actually hold a trade out for profit. You can use the next high because, like we said, right, it's a zone of liquidity. The only way that people pushed down from here was we had a lot of sellers up here. So if I just told you that we took out the buyers, what's the next move? We're probably going to go take out the sellers, and then so forth and so on. Like it literally just happens over and over and over again, right? We had buying power here, we pushed up, we didn't take out this high, so we came back down, took more liquidity out down here, right? Took out more lows down here, ultimately ended up in a giant push up, which is happening right now. If we go, let's say, to like the 4 hour, which ultimately ended up in a giant push, and that was that move right there. What I just showed you on the 1 hour, this is that move, but it had to come down here and take out liquidity in this area for it to be able to actually move up, right? It has to take out those other orders to regain money in the market and then push from there. And again, like you can use these highs and these lows as profit targets, right? For instance, we're seeing a market structure shift right here, so we might end up being bullish or bearish from this point right here to maybe sell back down to the EMA. Again, you wouldn't enter like in here because that's FOMO, that's fear of missing out. You're like, oh, price is moving down, I'm never going to be able to get in. So you enter here, and then you end up being liquidity as price comes back up because it has to retrace back up to get power to move back down. So you would wait for price to pull back into a zone that looks good, reject the zone, and then that's when you would sell off. And where would your take profit be? It would be the low that just got created, or the zone of liquidity right here. Okay, obviously it looks a little different because it's not being printed as we speak, so you're just kind of seeing after what it does, but you kind of get the general idea that, okay, we printed this low, pushed up, didn't take out any liquidity here, but now we know we didn't take out liquidity here, so we have to push back down again to take out more liquidity for us to actually push up and take out these sellers here. So again, it's just a giant pattern in the market. It is literally just a giant repeating pattern over and over and over again. Right? Like these lows right here didn't get taken out. You guys might be like, well, it's still pushing up and they didn't take out these lows. But at a certain period of time, the lows do get taken out here. And you know what that means? These lows didn't get taken out. Price is pushing up from here. All it's doing is taking out sellers on the left side over here from you know, previous days or whatever the case may be. It's just pushing up to take out their sell orders to be able to push down, take out these buy orders. So that's how the zone works. Are you using a liquidity indicator on TradingView? No, I'm not. I don't. No, this right here is just a EMA, and this right here, like this liquidity thing I have, is just a template, right? So I have the horizontal ray, which is just a line, and then I click here and I have liquidity. So like if the market was really moving right now, right, and I saw this low get printed, I would just put liquidity there. As soon as that low gets printed and we start pushing back up, I would put that right there, because now I know that, okay, this is a zone of liquidity. If I see price, you know, push back up, come here, take this low out and reject off of this EMA, I would have a higher probability to buy up from this zone instead of buying in here. That's kind of how I use it. I mean, some people's complete strategy is just entering off of a liquidity sweep and then just price just drops. It happens everywhere. If price doesn't close below a low, or it does a type of market structure shift around under other liquidity, right? This might look like, okay, well, it didn't close, it closed under the low, but that's when you have to go to like higher time frame and you have to see like, okay, what did the higher time frame candle do? Did the higher time frame candle sweep a low and then it just looks like that on the 4-hour candle? Because you got to remember, right? For one 4-hour candle to be printed, let's just say like right here, all right? For one 4-hour candle to be printed, 4 1-hour candles have to be printed. So like this 4-hour candle right here, this big bearish candle, this candle might be like big red candle 1 hour, big red candle 1 hour, big red candle 1 hour, push down, and then this wick right here that got created, this wick might actually be a bullish candle because there's a pullback in price right here, so it has to move up if this was moving down. So you got to kind of think about the candles like that. They all help form one another, and that's how the buys can be created. Again, if we see a low swept on a higher time frame on the 4-hour, that's when you go and drop down until, let's say, the 30-minute, 1 hour, or 15-minute, and you go to that exact low that just got swept, and then you see if there's any structure forming on the smaller time frame that is causing a reaction to that zone, which would be rejection, and then you wait for an entry somewhere in here based on, you know, your trading plan or how you trade, whatever your strategy is, and then that's where you'd find your actual setup is after liquidity gets swept. And it doesn't matter what setup you trade, there has to be some type of liquidity being swept for your trade to go in the way that you want it to go. Again, it's like a slingshot, right? If you want to move up, price has to move down first for you to move up. That's where you're going to find the best entry. Any questions? Any questions? No questions? So y'all get liquidity? Y'all get it? Y'all get it? It's just highs and lows. Zones where price can be selling from here, buying from here. And then you know that if price comes up here and takes this high but doesn't close above this high, we can maybe push him back down and take out this low. Like, it's really simple. Like, it really is. Like, I'm not sitting here and saying that trading is simple, because it's not. But like, people overcomplicate it. Like, that's all liquidity is, right? When you create a low, that's a zone of liquidity because there's buying orders under that low. There had to be buy limits down here because that's the only way price tapped in and got pushed right back up. So you know there's buyers here. At a certain point, price is going to want to take out those buyers because they have so much money being liquidated in the market by the market pushing up and giving them money that they think they're going to hold and hold and hold forever. And in reality, the market's going to come back down and take all these people that were trying to hold all the way up to here. It's just a big game of let me take your money.